our slideshow here. So hopefully everybody can see the slideshow for chapter 18, partnerships. I just uploaded the solutions to the midterm, and I will upload the solutions to assignment 3 as well after the deadline, so that you guys have that stuff right away. So let's jump into the topic of partnerships. Unless did anybody have any other questions before we continue? Everybody good with the in-class assignment? Just upload that if you can by I put 9 o'clock as the deadline there for that. So if you can get that in by then, that'd be perfect. And that'll fill in some of those participation points. So if there's no questions, we'll jump into chapter 18. All right, so partnerships is the topic, obviously, and we're going to just go back to a refresher here of who can do business in Canada, or what types of entities might do that. So we have taxable entities in Canada. We have individuals, corporations, and trusts. Also, a partnership can operate a business and earn income. The difference here is that the partnerships are not specifically taxed. It is the partners who are taxed. So those partners could be individuals or corporations. So again, individuals have a T1 tax return, corporations have a T2, and a trust has a T3. So they're all taxed directly. A partnership is a union of an individual or a corporation where they're engaging in this income earning activity together, but the partnership itself isn't going to get taxed. That is going to flow down to the partners. So that is what we're going to learn about here, is how do we calculate that? How do we do that? How do we send that partnership income to the partners in order to be taxed? So we'll talk a little bit about what a partnership is here first. So what elements do we have in a partnership? A partnership is going to include 2 or more taxable entities. So that's it, just has to have 2 or more. It's going to be carrying on business. That's why we care, and carrying it on with the hopes of making a profit. So that's what we're talking about. Whenever a partnership is formed, there's likely to be a partnership agreement. If there isn't, that's, it's a good idea to have that, right? You want to lay out that you're going to be more successful with the partnership if you have an agreement. Put it down in writing. How is this partnership going to operate? Now, in most businesses that are going to operate this way, they're going to have this properly set up. And the partnership agreement itself is going to be a critical document for us as the accountants, as the tax preparers, in order to understand the related provisions and what the rules are going to be about how this income is going to be separated. So inside the partnership agreement, we're going to have things like how much the partners need to contribute, right? Each partner is going to put in 500,000 or whatever. Also, the rights and the duties of the partners. So what do they have the right to, and what are they responsible for taking care of? Maybe one partner is dealing with the administration, and the other partners, dealing with, completing the work or something like this. We have to define the allocation of the profits and the losses. Right? What's the split? Is it a 50-50 split, 60-40, 3 partners, and it's you know, well, 33 and a third, 33 and a third, 33 and a third. How's it split up? These things would all be laid out in a formal partnership agreement. There could be information in there about the bank accounts, who the signing authorities are going to be, right? Who can approve payments, disbursements, and the like. What about procedures for bringing in new partners, right? What if we need some more money or some more talents to come into this partnership? What's going to happen with the existing partners? How do we bring somebody in? What about if we have death or withdrawal? Somebody wants to leave or leaves due to death, or they want to sell part of their business, their portion of the partnership. How do we deal with that? All of this stuff should be laid out in a partnership agreement so that it's set in stone, it's in writing, and we don't have to argue about this in the future. Now, that's the document. We're dealing with a partnership. The first step in our due diligence, we got to get a copy of that partnership agreement. And that's how we're going to be able to figure everything out based on those provisions. The final signed version. Now, there are different types of partnerships. So the first one we're going to talk about is the general partnership. So a general partnership is composed of partners. Those partners are called general partners. They manage the business, and they are equally liable for partnership debt as well as wrongful or negligent actions of the other partners. Unless it's specified, a partnership is a general partnership. So in other words, if you don't go to any other, if you don't do any other special setup, which we're going to get to in a moment, the other kinds, if you don't do anything special, your partnership is a general partnership. So that's the most basic version of a partnership, and all partners are equally liable for the partnership debt and the wrongful or negligent actions of their partners. Whoops. Now, a very popular type of partnership where you're going to go to a lawyer and get this set up formally is called a limited partnership. So this is a partnership where you have at least one general partner. So this is the partner whose liability is unrestricted. And then in addition to that, you have one or more limited partners. So we have a general partner and a limited partner, or multiples of each of those. So this is something that you would specifically register to be. Now, the general partner, they're taking on that liability. The limited partners, usually what this is about is they're just there for the money. They don't want to be responsible for anything else. Their liability is limited to the money they put in. That's what they're risking. They're going to come say, here's my 100 grand. I'm hoping, you're going to make me 200 grand, but that's all I'm responsible for. Just bring in the money. If anything else goes wrong, that's on the general partner. So that's a way to have some limited liability involved. Then the third one is the aptly named limited liability partnership, or the LLP. So this one is a form of partnership that's only available to professionals, right? So you would see this with legal or accounting or whatever, the LLP. So this is a specific version of this for professionals so that they can limit liability. So you're offering professional services, something could go wrong, you give bad advice, you're negligent, something happens. How's that going to work out for the partners? So members of a limited liability partnership are not liable for obligations that arise from the wrongful or negligent action of their professional partners. So if you partner up with somebody as a tax professional and they do something wrong, you are not going to be liable for that. Or employees, agents, representatives of the partnership who are conducting partnership business. So this is a way for those partners in a professional partnership to protect themselves from that additional liability of their partner, getting into trouble. So those are our three different: general partnership, which is nothing formal, that's just the way it is, and the liabilities equal and shared across the board for everything. And your limited partnership, where you have these limited partners that they're just risking their money. This is, by the way, this is very commonly used for, if you're doing land development. So you're building condos or apartments, something like that. You're going to need a lot of money. You're going to need, depending on the size, 15, 20 million, 25 million, whatever. You might bring a bunch of partners in to bring together that money. And there may be partners who are just coming to the table with money and they want to get a return on that. Have an ownership in partnership units. And the LLP again, accountants, lawyers, that sort of stuff. I'm just going to skip. We don't, there's some little blurbs here on joint ventures, syndicates, and all of that. We're going to focus on partnership. So your partnership income is going to be on an accrual basis, right? So this is just the same as your regular kind of GAAP income. You're going to have the same financial statements for the partnership. A partnership is the operating entity that's earning revenue, expenses. The partnership can hold a bank account, owe a debt, all that kind of stuff. For taxation year, you can have non-calendar partnerships. Generally speaking, though, partnerships are usually December year ends. It just gets a little bit more complicated otherwise. So, but it is possible for it to be a non-calendar. So one of the big things with this is that you've got income that's going to flow to the partners. That income needs to maintain its characteristics as it flows to the partners. So if you remember, we spent all of tax one learning about these different sources of income, right? We talked about dividends in chapter 7. We talked about capital gains in chapter 8, business and property in chapter 6. And they all had their own special rules, right? So dividends, you'd gross them up and get a tax credit. Capital gains, only half of that is taxable. Business and property, you've got different special deductions for rental income, business income, and all this stuff, right? So when these sources of income are earned in a partnership, they need to keep those same characteristics as they flow to the partner, so that those rules are consistently followed. So we're back to talking about the same thing we were talking about a lot in tax one, about grouping these incomes and following those particular rules. So it's very important that we maintain this. We don't want to change the nature of the income as we bring it in to the partners. It has to stay the same. The partnership property legally belongs to the partners, but for income tax purposes, it's deemed to be owned by the partnership. So we can claim a CCA deduction. We can recognize gains and losses, all that kind of stuff. So legally speaking, it's the partners that own the property, but there's a little bit of, it's treated a little differently here with the partnership itself. just for tax purposes. So how do we do this? We've got ourselves a nice little reconciliation. So we're into number crunching with the partnership stuff, and we're back to our reconciliations, like we've done before for income, but we're doing a special reconciliation here for partnerships. So we once again start with accounting income. So you're going to have a set of financial statements for the partnership. That's the entity that's operating the business. And so we're going to start with accounting income. So we start with the accounting income, and then we got a whole bunch of adjustments. So what are those adjustments? First off, salaries paid to the partners. We do not take a deduction for that. We add that back to accounting income. So specifically salaries that are paid to the partners, in the step, we're going to add it back to accounting income. Even though it's a salary, it's treated as a return of capital when it's paid to the partner for purposes of this calculation. And we'll talk more about this as we go through and look at examples. Partnership income adjustments. So interest on partner contributions. So if the partners might have, they started this partnership, they brought in some money. That's called a contribution. That's the money that partners put in. So say you got two partners, they each bring 100,000 in. That's their contribution. But they may have said, I'll put in 100,000, but you're going to have to pay me 5% interest per year. Like the partnership will pay me for that money as an interest payment. In that case, that interest is treated the same as those salaries. There's no deduction. It's added back to accounting income and treated as a return of capital. Again, this will make a little more sense when we look at it with some numbers. We're just doing adjustments here. Ultimately, everything's going to get taxed properly, but we got to go through the steps. Oh, and by the way, this is on partner contributions, which is different than loans. So partner contributions are part of the partner's capital. And one of the things we're going to do here is learn to calculate that capital account, meaning what is your investment? What is your position with the partnership? A loan is a different thing. If you just straight up did a loan, going to loan you 100 grand, pay me back over whatever period, and here's interest on it. Because the contributions, in theory, aren't set to be paid back necessarily. That's just what you're putting in to be a partner. So that's a different thing. A loan has the intent to be paid back. So there's no adjustment for that. Now, often what can happen is if you have some partners, those partners may have other businesses. They may become a part of this partnership because of certain business things that they bring to the table or could add, or another business they have could be contracted by the partnership, that sort of thing. Very common. So those transactions are fine as long as it's just regular commercial terms. So you happen to have a construction company and that company did work for the partnership that was building, an apartment building or something. Fine, as long as it's regular, terms of what you would normally do. We don't have to do any adjustments for anything like that. Capital cost allowance. So this is a little bit weird. So the partnership doesn't pay tax However, we calculate the CCA and deduct it at the partnership level before we pass that income down to the partners. So even though there's no partnership tax return per se, there is a partnership return, but it's not a tax return where you're paying a bill at the end. You're really just kind of saying, here's the income and here's who I'm giving it to type thing. So you do calculate CCA and take it out of that partnership income. The individual partners cannot deduct different amounts of CCA. It's just going to flow down from the partnership. Drawings. So this means taking money out. So if a partner just said, okay, well, I'm going to go into the account and just take out 20 grand. That's a draw I'm taking out of the pot. That money is not a deduction. Right? So that doesn't count as a tax deduction or any kind of a reduction in determining that partnership income. So we've got to add that back. And by the way, I don't have the page reference here right now, but there's one of those little figures where it tells you here's the things you kind of add and subtract. I find those can be helpful just as a quick reference as, you know, what have I forgotten? What do I need to add, deduct, whatever adjustments I'm going to make. So there is a figure there in the text that kind of gives you a snapshot of that. Oh, perfect. Thank you, Patrick. Patrick's saying it's on page 880. Perfect. Thank you, Patrick. So this would be similar to, you know, in a corporation, if a shareholder or director just draws money out of the bank, that's not a deduction for tax purposes. A proper salary would be. A dividend wouldn't be. Just a straight up drawing, taking the money out, also wouldn't be. Now, dividend income. So the full amount of the dividends is included in partnership income. So we don't gross up that income at the partnership level. What happens is it gets flowed through to the partners as dividends. Then the partners are going to do their gross up and tax credit. So if there's dividend income, so what we're talking about here is that the partnership, maybe the partnership owns shares in a corporation and is getting paid dividends. It's invested some money in something and it's receiving dividend income. Those dividends will flow through to the partners as dividends and get grossed up on the partners' tax returns, and they'll receive a dividend tax credit. So none of that stuff happens at the partnership level. It happens for the partners specifically. And additionally, that's going to be deducted from your accounting income to get what we call partnership business income. So that's what we're trying to get to, because if we take a step back here, ultimately what we're going to do is we're going to have this partnership business income. And if you have two partners that are 50-50, we're going to split that income 50-50. Your regular business income, that's going to flow to the partners as business income. But if you also have dividends, that's going to flow to the partners too. Perhaps the agreement is that that's 60-40. There could be different agreements on different types of income, depending on the arrangement. Likewise, when that flows through, it then has to follow the dividend rules. So that's going to be separate. We got to keep these things separate. So basically, if you're looking at accounting income, it might include a bunch of other stuff. It might include capital gains, dividend income. Like your financial statements would include all of those things. But we need to pull the dividends out, pull the capital gains out, so we have just regular partnership income, so we can split that specifically. So there's your taxable capital gains, like I just mentioned. So that stuff has to be, it's added to accounting income to get partnership business income. Political contributions, charitable donations, those are also not available to partners, or sorry, for the partnership. It has to be flowed straight through to the partners. So this is a deduction, so we're going to add that back to accounting income. Right, so it's the old, if it's been deducted and we want to get rid of it, we got to add it. So that's why we're saying add here, assuming that it was money coming out, right? So here, I think when they said added, that's because we had a loss. If it was a loss, we would add it. If it was a gain, we would subtract it. It's all about keeping the characteristics of the income to flow through the same way to a partner, so that it ultimately gets the correct tax treatment. If we left capital gains in and just flowed them through as if they were regular business income, then the partners wouldn't get the advantage of only having to pay tax on one half. Expenses of partners. So partnership can pay personal expenses just the same as a partner could draw money out, but that's not going to be deductible. So it's going to just be treated the same as a withdrawal. If you take the money out of the bank, or if the partnership pays for I don't know, the rent for your apartment or something, you know, that's not that's just going to be considered a withdrawal. And we're going to add, if it's been deducted from the financial statements, then we're going to add it back to get, again, to that partnership business income. So we're trying to separate out capital gains, dividends, and business income. So our reconciliation we're doing is to send capital gains away, send the dividends away, and make sure we have just business income so we can apply the rules as per the partnership agreement. How are we going to share that income? So the allocations to the partners must be made on a source by source basis. So you're going to allocate that business income, the dividends, capital gains and losses. If there's farming involved, farm losses, any foreign tax credits. And then again, remember these charitable donations and political contributions, those would flow through to the partners so that they could use the particular rules for those contributions and donations as they normally would, as if they had made that donation themselves. And you guys probably recall those rules from back in tax one about how we would calculate charitable donations. So it's just going to follow those exact same rules. And again, each of these items may be allocated on a different basis. It all depends, what does the agreement say? So step one, get your hands on the agreement, find out how this is going to work. That agreement's going to tell you how you're going to do all your calculations. Now, for you guys, obviously, doing your questions, it's just going to tell you the agreement says such and such. So that's one part of the task here, is how to calculate and separate that partnership income. So there's an in-class question here that I want to have a look at. I'm gonna share the solution here. So you guys have this on Brightspace, and you may or may not have actually looked at this question already, but it's problem 18-4 from the text. So I'll give you a minute to get that, and I'm just gonna log into the text here myself too, so I have the question in front of me. All right, so 18-4 is on page 902. And this question is about a couple of brothers, Saul and Samuel, and they're CPAs. And they decided, they used to work separately. They've decided to set up a partnership. So they're going to operate their accounting practice together now. It tells us that Saul will be entitled to a salary of, one sec, there we go. It says Saul will be entitled to a salary of $72,000 per year, while Sam will have a salary of $48,000. Tells us that Sam will receive interest at 6% on his average capital balance for the year. So that's the money that he's put in. That says all of these amounts were withdrawn from the partnership prior to December 31st, 2020. Neither brother has taxable income that will be taxed federally at 33%. Now it says the components of their partnership agreement dealing with income allocation are as follows. So it's got a spot right there in the middle that tells you how the income is going to be allocated. And you'll notice that it specifically mentions for business income, capital gains, and dividends. So those could be the same or they could be different. So for business income, it says after the allocation of priority amounts for salaries and interest on capital contributions, the remaining business income will be 60-40. So it specifically says remaining business income 60-40 after allocations for salaries and interest on capital. So it's specifically letting us know what comes out after that. So this reconciliation here might look a little bit weird because we're doing a little bit of this adding and then subtracting. So we're starting with our net business income, which is given in the question. It says that the net business income on the financial statements, right? So this is per your financial statements. It says in the question that it's 649,522. Then it tells us that they received salaries of 120,000 and interest on capital of 4,800. As per the reconciliation that we're supposed to do, we are supposed to add those back. So we have done that. However, their partnership agreement says that the calculation of the 60/40 is after allocating the priority amounts. So down here, we take them back out again. So it's just the specifics of how that's worded in the agreement tells us when we're going to do this 60/40 split. So basically they've decided, okay, I'm contributing this, you're contributing that. We're going to pay a regular salary, get a T4, right? So this would be, salaries would relate to their efforts or their real work. And then something like interest relates to the dollars that you've put in. So depending on what the partners are bringing to the table, it's not necessarily going to just be a straight 50/50 split on everything. So after all of that stuff's worked out, then the remaining balance is a 60/40 split. That's what they've agreed to. There's some other items on here. Regular, you'll notice some of these items on the reconciliation are just the same as they would have been when we were a few chapters back working on corporate, figuring out our taxable corporate income. So you've got your basic stuff. And we would have also even had this back when we were doing T2125s for self-employed folks, right? Business, meals, and entertainment. Only 1/2 of it is taxable. So we have to add back half. Amortization expense, same thing. We don't use amortization for tax, we use CCA. So whatever amortization is, we add it back. Charitable donations. This one we're adding back because we can't deduct it here. We have to flow that. It's got special rules, so we have to flow it to the partners as a donation amount they can put on their personal returns. So we got to add that one back as well. Then on the deduction side, well, we're going to deduct our CCA, right? So some of this stuff is the same stuff we've been using in our reconciliation, standard stuff. Half of meals, CCA instead of amortization. But then we got some other special partnership type ones. So some of this is stuff you'd already be familiar with. So we do this little reconciliation, and that gets us to our residual business income. We're going to split this number right here based on the 60/40 agreement. Whoops. Now, in addition to that, we have to keep our capital gains and our dividends separate, right? Keep those out of this. Now, in this question, it stated the business income, it stated the salaries, the capital contribution amount. Flip to the next page. It gave you the business meals, the amortization, the charitable contributions, all that stuff was on the top of page 903. Tells you what CCA to deduct. Then it's number 2. So other information, number 2 on page 903 says the partnership has 2020 gains on the sale of shares held as temporary investments. So the partnership has bought some shares and they're holding them as a temporary investment, but they sold them and had gains on them. So it says that the gains were $16,164. So the taxable portion of that would go to one of the partners is going to be the 1/2. Now, as per the partnership agreement, because there was a special portion of the agreement for capital gains, it read, as Samuel has contributed the majority of capital to the partnership, he will be entitled to all capital gains recognized by the partnership. So here we're just calculating what that taxable amount is. And then down below, we're giving all of that to Samuel. For the dividends, it says any dividends received by the partnership will be split equally. So capital gains, those are going to Sam. Dividends are a 50-50, whoops, 50-50 split. And the other stuff, 60-40. And in addition to that, they did get salaries and interest as per the agreement as well. So when we line up all of the income for these guys, it's going to look like this. So we have the priority amounts, we call them, salaries and interest. Those were paid directly to them. So like these guys, for these salaries, they would have T4s. For the interest, maybe there should be a T5 slip. So that's going to be on their personal taxes, just like that, just like a regular employee in that sort of situation. Then we've got our residual business income, 60-40 split on the number above. Then capital gains, we agreed that all of the capital gains, this is the taxable amount, will go to Samuel. And then the dividends, we just have to do our gross up. They were eligible dividends, so that's 38%. So you guys should remember that stuff, that little bit of basic gross up and tax credit stuff from back in chapter 7. So some of these little things we learned before are gonna pop back to haunt us here. Oh, sorry, I saw Grayson's question. Would all the partners' income sources, residual salary, and investments be reported on? Oh, okay. Or would they receive? Okay, so I answered that question. Anyways, perfect. So the amounts we're putting here in these calculations, we're trying to get to income for tax, right? So we're flowing through the rules. So we're grossing up the dividends, and the dividends is a 50-50 split. So we're just giving half to Saul and half to Sam. So again, the whole point of all of this is to take the income that the partnership has, split it to the partners appropriately based on the agreement, also making sure to keep the characteristics of the income flowing through consistently. We can't just dump this all in a pot like it's all business income and split it 50-50. We have to follow the rules, and when it's dividends or capital gains, we need to flow through so that we can do the gross up tax credit, do the half inclusion rate, do those rules that we've learned from back in tax 1. So net income for tax purposes for these guys, that's how much is going to come to them from the partnership. Some of it on slips with the T4 and T5, and then some of it as go back to the chat here. The question that Grayson was asking about, she's talking about a T5013. So the T5013 is the slip that the partnership would issue for the other types of income. So it's a statement of partnership income. So that's those priority amounts would be covered under the appropriate T4 and T5 slips. But then the partnership needs to report each of the partners' income so they can then pay tax on that. So we'd have a T5013 as a slip that the partnership would have to issue to send that income to the partners. Or it could be a loss, right? It's not always income. And then partnership losses could potentially be used as well. Down here in the tax credits section, it mentions about the donations. So we also have to send along potential tax credit stuff. So the donations, each of the brothers are going to get 50% of those donations. And then there's a little basic calculation, right, that we would have learned back in chapter 4 on how to calculate what that tax credit means for each of them. So you can do a little quick analysis there on the charitable donations as well. So that's tax credit. So we need to divvy up the income, but also the tax credits. So the dividends would also have a tax credit. So if you guys are looking for how to calculate these, right, that's back in chapter 7. If you need a refresher on how to do that, we learned that back in tax 1. And these credits is still the same. So they agreed the dividends were going to be split 50-50. So the dividend tax credit is split 50-50. So the job here is to figure out how much, how much income and how much tax credit are going to flow to each of the partners. And that's how you go, all based on keeping those characteristics and following the rules of the partnership agreement. So some of the stuff that's built into this question, we've already learned before, right? So that carry forward knowledge is helpful here. We already knew what to do with meals and entertainment. We already knew what to do with amortization and CCA. We already knew how to do, grossing up and taxable capital gains, inclusion rate 50%, all that kind of stuff. We already knew that from tax 1. Now, I'd like to also run through, I know we're getting a little tight on time here, but I want to just get through question 18.7 as well before we call it a night here, so you guys have everything for chapter 18. So I'm going to run through this one as well. So it's problem 18.7. Actually, I forgot. What I want to do first is quickly back to the PowerPoint slideshow. So the next thing that was in the slideshow here is this concept of partnership interest. So the interest is important because that's going to be kind of like your base for what you have as a partner in that partnership. So if new partners are coming in or partners are going out, that is going to be a relevant number. So there's different things that are going to be adjustments to that cost base for you, to that partnership interest. And there's some issue here with timing, which is important as well. So capital contributions, that's the money that you put in, and drawings, which is the money that you take out as a partner, those are going to be added or deducted, right? So added if you put the money in, deducted if you took the money out from your capital account whenever you put it in or whenever you withdraw it. So pretty straightforward. So you've got a capital account. If you put in 100 grand today, your balance is 100. And if you take out 20 grand tomorrow, then tomorrow your balance is 80. Here it was 100. Pretty straightforward. Nothing too strange there, right? Whenever you take it out, put it in, it affects your account. So that's pretty straightforward. But we have other things that affect your account as well. The partnership income or losses also increase and decrease your account balance. So your portion of the income or the loss, what we were just calculating a moment ago, that adjusts your account as well. But the timing matters. It's actually added or deducted, if it's a loss or an income, on the first day of the following fiscal period. So this is a weird one. That whole year dumps in the first day of the next year. So it's like, here's what we did for 2020. That hits your account January 1st, 2021. That timing matters because if you were selling your portion on a certain date, you need to know when this adjustment's going to factor in. Also, charitable donations and political contributions, same thing, deducted on the first day of the following fiscal year. So if you put real money in, take real money out, that happens when it happens, right? But these annual statement amounts adjust once a year at the start of the next year, first day. So that's just a timing thing, but can be important. Dividends, same thing, added on the first day of the following fiscal year. And there is no gross up when we do this. Not for this purpose. We just did the last calculation. That was to show what that individual was going to pay tax on. We had to do the gross up. For the balance of the account, we don't do the gross up. Capital gains and losses, the full amount is added. The net amount, if it's a loss, so if it's a gain, you add that. If it's a net loss, you do that. That is also on the first day of the following fiscal year. So you'll notice pretty much all this stuff is first day of the following fiscal year, unless it's literally the partner putting in money and taking out money. All the other income statement stuff is going to hit first day of the following fiscal year. If that balance of that account, and we're calling that the ACB, so that's like your cost base of your partnership interest. So like if your account is at 100 grand, that's your cost base for your account. So if you sold that interest for 200, you've got a gain of 100. So that's why it's important. We need to know what your base is in case you sold it. So this partnership interest, it's also your cost base. If your cost base, due to this math and the way we do this, goes negative, generally speaking, that means we have to have some income. So we can, if you do a calculation and you get a negative balance in that account, that means you've got income. So to give you an example, if your account balance, your cost was at 100,000. So say a brand new partnership, you walk up, you go, okay, I'm going to put 100K in. There we go. I put that into the partnership. That's my interest. Nothing else has happened yet. And then I walk up the next day and I take out 120K. And I go, excellent. I'm done. We don't do anything else. We don't operate. Well, you just got an extra 20,000. You invested 100 and you took out 120. You made a profit of 20. Your account would be negative 20. Right? That'd be your ACB. So in other words, you made a profit. Geez, that A won't stay there for some reason. You made a profit of 20K. If your account is negative, you made a profit of 20K. So we got to put that into income. That's the why for the negative ACB. So with that in mind, I want to take a quick look at that other question, and then we will call it a night. So this is question 18-7. We're going to calculate an adjusted cost base, right? So the also called the partnership interest, same thing. And then we're going to say what happens when you dispose of So I'll go back to the solution here. Okay, so you guys should see the solution to assignment problem 18.7 on the screen. And I'm gonna pull up the question on my screen. All right, so 18-7 is on page 906. And we have three people that have a partnership. It's Tammy, Loretta, and Crystal. They formed a partnership on January 1st, 2018. And they've decided to offer a variety of consulting services. Each partner comes in and makes an initial contribution of $270,000. It says they agree to have a December 31st year end. So that's important because we know timing is going to matter. So a lot of things are going to hit the account January 1 of the next year. It tells us some information about the partnership agreement. It says the partnership agreement contains the following provisions with respect to the allocation of items to the individual partners. So both net business income and charitable contributions are going to be shared equally. So a third, a third, a third. Any capital gains realized by the partnership will be allocated 50-50 to Crystal and Loretta. So Tammy's not receiving any of the capital gains. And it says all of the eligible dividends will be allocated to Tammy. So Tammy's getting the dividends, Crystal and Loretta are splitting the capital gains, and all three of them are going to share equally on that net business income, as well as charitable contributions. So then it tells us that through 2018 to 2020, the partnership is successful. It earned business income of $315. It received some dividends, capital gain, made some donations. Tells us Tammy, Crystal, and Loretta's withdrawals, right? So again, withdrawal just means they took money right out of the partnership account. And it mentions that some additional capital was required. And so that initial capital of 270 went in, but each partner also put an additional 104 in. They needed to expand their office. They needed some more cash. So that happens, right? You've got partners, they start out putting money in, and then later on, it's like, hey, we're going to do something new. We need a little more money. So everybody pony up and put some more money in. So that's the additional 104. So everybody contributed 374 in total. It says near the end, so now I'm on the top of page 907. It says near the end of 2020, after a number of heated arguments, it's about to get spicy here, I guess. Tammy and Chris, heated arguments between Tammy and Crystal regarding the types of clients the partnership was servicing. Loretta decides to withdraw from the partnership effective Jan 1, 2021. So Tammy and Crystal were not getting along. Loretta didn't want the drama, and she's going to beat it. She's getting out of there. So no surprise, partnerships do not always work out. They're not always profitable, and the people in them don't always get along. And so it's important that we can figure this stuff out because people are going to come and go from partnerships. So we need to know what that interest is worth, what that cost base is for tax purposes. So looks like they came in with the best of intents. They got a proper partnership agreement, but it just didn't work out. So now we have to go through the motions of how to deal with this. So it says Loretta decides to withdraw January 1. It says after some negotiations, each of the partners agree to pay her $210,000 in cash for one half of her interest. So she's going to sell all of her interest, but each of the other existing partners are going to buy half of that so that they're, in the end, 50-50 partners. So 210 plus 210 is 420. The payments are made on February 1st, 2021, and the partnership has net business income of $27,600 in the month of January 2021. So you can see those dates, and so you should be thinking, oh, okay, so there's something going on with these dates, this timing, all these timing slides Andrew just went through. That's why that mattered. We're going to have to consider that. It also says that Loretta incurred legal and accounting fees as part of getting this withdrawal done, and that was $2,300. Geez, sounds pretty cheap. Not too bad. So required. First thing we want to do, this is part A. First thing we're going to do is calculate Loretta's adjusted cost base of the partnership as of Jan 1, because that's the date that she's leaving. So we're worried about Loretta, and we're worried about Jan 1, because that's her leaving date. So we have her initial contribution, her additional contribution. The question told us how much she drew out. Over those years, she took $72,000, her specifically. That stuff hits when it happens, so that's out. We know what the net business income was during the period. We don't have to calculate it because in this one it was given to us. So that's what we would have calculated in the previous question, right? Here, we were lucky enough to just kind of have that given to us. Partnership earned net business income of $315,000. So she gets 1/3 of that. That is an addition to her partnership capital account. When it's profit, it adds to it. If it was a loss, it would subtract. Capital gains, those are split 50-50 between Crystal and Loretta. So she gets 50% of the capital gain. However, so it's a 50-50 split. And it says that the capital gain, it says the partnership realized a $24,800 capital gain. So 50% is $12,400. I will draw your attention to this note here, though, for some clarification. Only the taxable 1/2 of the capital gain is included in the partner's income on the flow-through capital gains realized by the partnership. However, so, right, we already know if you have a capital gain, you only pay tax on 1/2. Fine. It says, however, the remaining 1/2 is included in the assets of the partnership, and in the absence of a special provision, the realization of this amount will be added to any capital gain realized on the disposition of the partnership interest. Given this, the full amount of Loretta's share is realized capital gains is added to the partnership adjusted cost base. So what they're saying, so this 50% is for the split. This has nothing to do with, this is the Crystal and Loretta split. That 50% has nothing to do with our inclusion rate of 50%. It would have been nice if the question didn't use 50% there, so it'd be a little clearer, but that's not what that's for. That's for the Crystal and Loretta split. The 24,800 was the pre-tax capital gain. Whenever it says capital gain, that means pre-tax, like the real world amount. If it says taxable capital gain, it would be the 1/2. So the partnership realized a $24,800 capital gain, 1/2 of which would be taxable in the hands of the partners. But we're not worried about that in this question. What we're worried about is how much of that is going to Loretta. 1/2 of it is, and the whole thing's staying in. When we do it to this account, we just add her whole capital gain amount. So this is capital gains, not taxable. So we don't have to take 1/2, 1/2. We're only doing the split. Now, again, this is creating her cost base. So this is going to reduce her taxable amount when she sells it. So that other 50% of the capital gain that's not supposed to be taxable can stay in here. So that's what that's all about. Dividends, well, they all go to Tammy, so there's nothing there for that. Charitable donations, that would reduce this account. So she gets 1/3 of that as a reduction. So there we go. We have calculated her adjusted cost base as of January 1, 2020. You will notice the net business income. It does not include anything other than the income up to the end of December, right? 31st, 2020. So she's pulling out January 1, 2021, right? Just make sure I got my dates right. I think I got that right. Yeah, so she's out January 1, 2021. That's the date that she is out. So the income that's involved only goes up to December 31st, 2020 to calculate that she's going out on that date. So that's important to note as well. So the last bit, we're almost done. Part B, the question says, this is what it's all about, determine her gain or loss, right? So we know what her partnership interest is. She's selling that partnership interest. So that's a capital asset for her. She's going to have a capital gain. So her proceeds, that was given in the question, she was going to receive $420 from the partners. We just calculated her cost base. So that's $416,100. She can also claim the legal and accounting fees, right, to reduce. That was a selling cost. So she can claim both of those. So her capital gain ends up only being $1,600, half of which is taxable. So you'll notice we've now factored in the half, and it's only $800 of capital gain. So that would end up on Loretta, the one who's leaving net income for tax purposes in 2021, right? Because this happened, it was executed for January 1, 2021, and that's that first date after when that income gets applied in. That's why they would have picked that date. So 2021 as a taxable capital gain. She would not, as a note, include any partnership income from January because it was not allocated. That's what all those slides about timing we're talking about. It just magically drops in once a year. It's kind of weird, but that's just how that works. Now, the last bit, how does this affect the other partners? So it says, indicate how the adjusted cost base of each partner's interest would be affected with the withdrawal of Loretta. So that's pretty straightforward. The fact that each partner paid $210, so they each paid $210 to get the 420, right? That was 210 times 2 for each partner. So they each paid in 210. So what that means is that Tammy and Crystal would add 210 to each of their adjusted cost base or interest accounts. And that is that. So I see it's about 8:32. Thanks for hanging on, guys. I know we went a little bit over time here, but I just wanted to make sure to close right out there of the partnership chapter. That's everything that I wanted to focus in on. We will come back on Wednesday with another live class. It will be covering HST, chapter 21. We will have another in-class activity. I think what we'll probably be doing is just kind of filling in some, maybe a HST return, something like that. Just a little bit of in-class activity for that one too, so we can earn some of those participation points. And so that will be the focus of Wednesday's class. And thanks a lot, everybody. Have a great night, and we'll talk to you on Wednesday. Also, don't forget to submit your in-class, the one we just did, the 2057. Make sure that it's saved as a separate Adobe file and that there is content in it before you upload it. Just open it up in Adobe and make sure it's filled in. if you use the browser, you could have a problem with that. And also don't forget, if you haven't already submitted it, assignment 3 is due as well this evening. And I think that is it. Thanks a lot, guys.
I have a question before we leave.
Oh, sure. Yeah, absolutely.
Did you post assignment 4 and the solution for the midterm yet?
So I posted the solution for the midterm, and I will post assignment 4 for you guys as well. I haven't put it up yet, but I will do that right away.
For some reason, I don't think we can open the solution. For
Oh, okay. Let me check on that right now. Maybe it's just hidden or something.
It's there, but you cannot open it.
Oh, you know what it is? It's because, all right, hold on. It's the whole category. It's because of where I put it. I put it in the exam category there. Let's put that. Okay, try it now. It should be, you should be able to see it now.
It's work. Thank you.
Okay,
Professor,
no problem. Thanks.
I have
Thanks
a
for
question
mentioning.
too.
Yeah, absolutely.
I'm unable to save my form, and I did not do it in the browser. I did it in the Adobe software. So what I did was I took a screenshot and made it as a PDF file. Would that work?
Yep, that's absolutely fine too.
Oh, okay. And will we have tax forms in the final exam?
It is possible. Yep.
Okay. Okay, sure. Thank you.
Okay, no problem.
Bye-bye.
All right, have a great night, guys.
You too.